please help me welcome Jamie Duran, President of Southern California.
Hello, welcome everyone. Welcome to the Southern California Real Estate Market Update and Forecast today. We are thrilled to have you all here. We're also thrilled to have Jordan Levine, Vice President and Chief Economist at the California Association of Realtors, to deliver this incredible update. Today, we are going to discuss the shifting market, and we're going to talk about what it means to you as a realtor, what it means to you as a seller, a buyer, an investor, and the opportunities are truly everywhere. We just have to keep our eyes open and get educated in the facts. With that, please welcome Jordan Levine, and hopefully he's out of his RV finally. Welcome, Jordan. Thanks for being here with us.
Yes. Thank you so much. I'm back on dry land, as it were, and appreciate the opportunity to be here talking about SoCal. That's where I'm born and raised, and so it's nice to be able to have the opportunity to talk about where I grew up. And yeah, I'm a diehard Californian, and I think you hit the nail on the head. There's a lot of opportunities out there. I think my goal today is to talk everybody down from the ledge, number one, and number two, give you some tips about the kind of recipe for success as I see it, based on the data, because the market is shifting. And I think on the one hand, the clients need us more than ever. But on the other hand, we need to have a kind of foot on the gas type of approach to our own individual business. And I think for me, the recipe for success, not just to get through the next 12 or 18 months of this market shift, but really to set your business up for success over the next 12 to 18 years, is to kind of really embrace that role as the trusted advisor, as the market expert, right? And to really be there for our clients, because there's a lot of scary headlines out there. And I think especially those, and you can hear my analysts there in the background, but there's a lot of fear and trepidation and hyper focus on the short run, and maybe a little bit less focus on the long run, which is what home ownership is all about. And especially when you think about what we tell home buyers in a market like this. On the one hand, there are some negatives, and there's what I call the brother-in-law effect that's happening out there, and literally everywhere I go, including when I went and bought a new car the other day, the guy said, oh, you're the chief economist at CAR. He goes, my brother-in-law just told me that prices are like about to tank. And I hear this everywhere I go. And so just the psychological impact is out there and alive and well. But I think, buyers are kind of losing the perspective and forgetting the bigger picture, right? That actually, aside from the higher rates and the effect on purchasing power, market shifts are typically good things for buyers, right? The market's been hyper competitive. Now it's a little bit less so. There's more inventory out there to choose from, and that's really been our Achilles heel up until this point in the recovery. And of course, I think the long-term benefits of home ownership, which is what we get into housing for in the first place. It's not about buying low and selling high and timing the market and all of that stuff. Home ownership is the one proven way that over the long term, households and families in America actually create wealth. And I think the long-term wealth creation prospects, the appreciation, particularly in Southern California, is kind of unmarred by the current challenges, right? We have economies that go up and go down, and business cycles and all of that stuff. But the fundamentals in California are such that we have too many people and not enough homes to put them in, meaning that, over the long term, again, prices in California only ever go one way. Part and parcel of that brother-in-law effect is folks thinking that it's 2008 all over again. And of course, when you look at the fundamentals that we had, particularly in housing coming into this market shift, we had, very tight underwriting standards, people that were putting money down. We were really only originating mortgages to folks with 700 FICO scores, et cetera. And so, even as we're potentially in for some tough economic times, I don't expect that the housing market to kind of see the bottom fall out the way that we did last time, and certainly not a major foreclosure crisis the way that your brother-in-law's kind of email newsletter campaign suggested. What about sellers, right? Because sellers are obviously facing some challenges as well, and they're going to have to reconcile with the market shift. There's less buyers out there. mostly due to that purchasing power effect of higher rates. But as a result, a less competitive market means that homes are taking a little bit longer to sell. There's not as many homes that are closing above list price, and that there's a little bit more discounting from other sellers going on in the background. And this is where I think our job is to really help to provide perspective, right? Where we want to show context and things to the buyer and get them more focused on the long run rather than the most recent headline they just read. For sellers, I think it's all about managing the expectations, right? Because even as there's fewer buyers and the market's not as competitive, it's still a good market. We've just been really, really spoiled by the last couple of years where we had this surge in buyer demand and a huge reduction in supply. And outside of the last couple of years, if you judge it by more historical standards, homes are still selling pretty quick, just not by the standards of last summer. Home prices are still pretty high, and we've yet to see broad-based price declines, especially in Southern California. And even though we're not getting 80% of homes roughly selling above list price, we're still getting about 25% or so. And so it's still a good time to sell. Inventory is still short, but we just need to make sure that folks aren't going in expecting it to be the kind of spring home buying season, because we were in an environment with 3% rates and the market was red hot, and it has shifted since then. And so again, that doesn't detract from your ability to sell your home and make a lot of money on it, but you just need to go in with more level set expectations, be a little bit more strategic. And again, these are conversations I think that are best had on the front end, right? During the listing presentation and all of that stuff, not when the home's been sitting on the market for 20 or 30 days and your seller's thinking that you're not doing a good job of marketing their property, right? So that is how I think we've got to shift the conversation with our clients out there. What does it mean for us in terms of our own individual business, right? On the one hand, I think we're going to see sales that are going to remain relatively low. And that's why I said we really need to embrace that trusted advisor role, because unlike last time in 2008, where prices were really the thing that suffered most, I think sales are going to be the thing that just kind of stay low, because you've got a lot of folks locked into these mortgage rates that are at or near all-time low levels, and that really diminishes your incentive to move when rates have now climbed so much. A lot of potential buyers may be priced out of the market, and you're not going to have as much buyer demand, certainly not the kind of white hot amount of buyer demand that we had last time, and the market will be less competitive as a result, right? But that's, again, good news for home buyers who are still in the game, who can still qualify, who still want to get their foot on the property ladder and reap those long-term benefits, right? We do think prices are going to come down a little bit, even though it's not going to be a major foreclosure crisis that your brother-in-law suggests. We do think that prices have been set in an environment that was based on 2.5% mortgage rates, give or take, and with the purchasing power impact of higher rates, we will see prices kind of correct a little bit. The thing is that inventory is still incredibly tight, and without a big foreclosure crisis, we're not going to have the inventory that's going to be needed to drive major price declines the way that we saw in 2008, the way that your brother-in-law says we just have to wait until next year for that stuff to materialize. But at the same time, that's the thing that's probably going to keep sales pretty low, because we can't sell obviously what's not for sale, and I think that's going to be the big challenge as we move forward, is just how do we continue to generate new inventory when folks are a little bit trepidatious to move. And so ultimately it comes down to just being a market share game, and why I said, you want to keep your foot on the gas and your nose to the grindstone, because I think that although the market will probably find bottom next year in terms of sales, it's going to be slow getting back to the 400,000 or 500,000 units that we've done for the last couple of years, meaning that those agents that really do embrace that trusted advisor role and kind of hitch their horse to the consumer's buggy, right, and really deliver on that expertise are going to be the ones that not only survive the next couple of years, but will be set up for long-term success for the next couple of decades as well, because you're going to have clients who really needed you and who you really helped out, and are then going to be incredibly loyal to you as you move forward, and that's the name of the game. So let's get the bad news out of the way. This is the stuff that our clients are super freaked out about, right? And we saw last week, or a few weeks ago now, I guess, that the Fed they've kind of continued their war on inflation and are kind of constantly finding themselves battling back and under predicting the measures that they were going to need to take to unwind some of the kind of stimulative pressures that they put on when things were looking fairly scary. Of course, we know about the supply chain aspects of inflation, right? That at one point, and this is the New York Fed's kind of global supply chain pressure index, and I won't belabor and nerd out on this too much other than to say it went really high last year, right? That we were seeing the supply chain be impacted by the fact that workers weren't being put into those factories to punch out computer chips and cars and all of that stuff. This has begun to fade. The supply chain, although not totally fixed, has started to come back online. People are getting back to work. The reason why I think inflation is going to be more persistent, though, is because, it's not just the supply chain issue. And one of the big kind of lasting impacts of the pandemic is that U.S. labor force participation went down a lot and is yet to fully recover. And so we still don't have everybody back to work, and it's creating this kind of labor shortage that on the one hand is generating above average wage growth, right, for those folks that are actually working in demand occupations, right? Notwithstanding the recent layoffs in tech and things like that, the labor market is still incredibly tight, and it really comes from two sources. If you look at why labor force participation is down, on the one hand, it's from 20 to 24-year-olds, right? And you have a lot of folks that are just getting comfortable, kind of living on mom's couch and all of that stuff that have yet to go back to work. And then also the 55 plus category, right, which is down whether you measure it in percentage points or percent. You had a lot of early retirements in the wake of COVID. You had folks who had incredible amounts of home equity that had accumulated, right, that you've got a stock market that also surged after that initial shutdown. People were feeling more wealthy. And I think you had a lot of folks who just kind of cashed in their chips, went into early retirement. This is something that's not easily fixable simply by raising rates. Presumably, these 20 to 24-year-olds are going to eventually, get motivated to move out of mom's house and all of that stuff. But thus far, it's been a big challenge. And even if these folks do go back to work, they're not necessarily in a kind of career level position to be able to slide into some of these early retirement jobs. We kind of lopped off the top end of folks in terms of experience and skills and expertise and all that stuff, and not these, these folks aren't necessarily the same ones that can come in and fill those jobs. And that means that the labor market, which is already running about a 5 million person gap between the number of folks that are actually working or looking for work and the number of jobs that we actually need to put people into. And again, that's why I think even as the supply chain starts to sort itself out, the Fed's going to have to remain pretty aggressive because, again, interest rates in and of themselves don't fix labor force participation and get older folks who've retired to go back to work immediately. The other thing I'll point out is that we also really pumped up the system with a lot of monetary stimulus, and I don't want to get too esoterically nerdy on the macroeconomic data, but the money supply was growing by quite a bit. In fact, at one point last year, M2, which is the kind of econ nerds way of saying currency, checking savings accounts, money markets, the amount of money that we can actually get our hands on in short order was growing by almost 30%. And if you compare that to like the 2008 financial crisis, when we also did a lot of monetary stimulus, most of that just sat in bank vaults, right? We weren't putting money directly into folks' hands, and that only exacerbated the supply chain crisis and drove inflation even stronger than we've seen in a very long time. And of course, when you have lots and lots of demand pumped up by stimulus and hyper low interest rates, the inflation that we see is kind of a logical conclusion that my Econ 101 professor would have suggested that we should expect. The good news is we're probably past peak inflation already. Back in June, we were running about 9% on a year-to-year basis. That means the cost of everything from gas to haircuts and rents and car washes were on average going up by 9%. That has since dipped down to 7.8%. And if you're watching the stock market, they were really celebrating that in conjunction with the Fed's kind of suggestion that they were going to be a little bit more data driven. But 8% inflation is still pretty high. And I think that's going to kind of keep the Fed relatively aggressive, and maybe the stock market's a little bit premature and kind of celebrating the end of inflation, because it's going to take us a while to get back into that 2% Fed target range. Again, because a lot of this is both monetary stimulus that's already out there sloshing around in the system, and a labor market that's way out of whack with a lot of unfilled positions that's going to keep wage growth relatively strong. What does that mean in terms of the kind of economic outlook, right? I think that unfortunately, even as we're past peak inflation, it's going to take a while to get that under control. And that means that consumers who really have driven about 90% of the growth during this economic recovery up to this point are going to start to run out of gas. We've been able to maintain growth in an environment with 8-9% inflation, but it isn't because wages are driving all of that, right? Wages are growing by more than they normally do, but it's still about 6%. And so what we've seen is that consumers have had to continue to supplement their income by drawing down their savings, and more importantly, especially recently, really running up those credit card balances. And you can see here that revolving debt on the right-hand side was growing by 15% on a year-to-year basis after having already rebounded at this point last year. And so that is ultimately going to cause us to lose some momentum, right? You can't sustain spending predicated on credit cards and savings rates, because savings eventually fall to zero, and eventually also credit cards can get maxed out. So I do think we're going to see this, coming to grips with inflation coming at the cost of the broader economy. And of course, if you look at some of the forward-looking indicators of recession, it does suggest that we'll see a modest one next year. This is the yield curve, which is the difference between 2-year interest rates and 10-year bond rates. And what we see here is that going back over the last 30, 40 years or so, every time 2-year rates jump above 10-year, which kind of the layman's interpretation of that is that people don't want to buy 2-year bonds, right? They're worried about the short run of the economy. When we see that happen, we call that an inversion of the yield curve. And we've been now inverted in 2020 for the last 135 days consecutively, right? We've been inverted for the last 20 weeks. And this is one of those indicators that is kind of batting 1,000 when it comes to predicting a recession. And so we can expect that at least the bond market rather expects that we will see that consumer step back a little bit as we get into 2023. We're also seeing real net worth on a per capita basis, which is another one of these great indicators for predicting a recession, finally tipped negative in the second quarter. So folks were actually getting poorer on a per capita basis for the first time in several years, and that typically and probably intuitively is not very good for the economy. When I feel poor, I don't go out and spend as much, and you can see that's historically been closely correlated with recessions as well. So we have this kind of Fed war on inflation, I think, coming at the cost of consumers, and it's also having an impact for us a little bit closer to home when it comes to the housing market, right? And we saw actually that although rates went down a bit last week, right? The Freddie Mac 30-year fixed rate mortgage rate dipped to 6.61% from 7.08%, I think it was the week before. We're still essentially up about 300 basis points from where we were when rates were at an all-time low level back at the beginning of last year. And this has a huge impact on purchasing power, right? That folks simply won't qualify for as much home as they used to, and that will take some of the wind out of the sails of buyer demand, right? In the same way that we, at the onset of the pandemic, going from 5% down to 3% rates added about $150,000 worth of purchasing power to the typical, $150,000 a year household. That same process is now going to start to unwind itself as rates have gone from 3 to close to 7%. You can see that purchasing power impact starting to move in the opposite direction. And that means that some folks will be able to absorb or buy a cheaper home or put money down, what have you. But at the margins, there's some folks who probably will no longer qualify for homes that are available in the neighborhood where they want to buy, right? And you can see that if you take the $900,000 median priced home that we hit in California this year, and you look at the payment on that home going from 3 to 7%, it adds about $1,700 a month. And again, there's folks out there who aren't going to be able to absorb that kind of increase and won't be able to tap into equity from mom and dad or what have you, to kind of bridge that gap. And I, think that's why we can expect that demand will be impacted. Although in an environment of rates that are expected to continue to rise, I think that it still makes sense to buy over the long term, right? And we actually put together a little purchasing power calculator on our website where you can kind of talk to clients about the long-term impacts and what it means in terms of monthly payments by waiting for rates to go even higher, right? Because if you take a household in San Diego, which I just picked out as an example because that's where I grew up, making 150 grand a year, relatively conservative appetite for risk. They're going to put some money down. They want a relatively low debt to income ratio, meaning that they want a monthly mortgage payment that's about $3,800 a month. Well, if you go back to the beginning of this year, when rates were running about 3%, that household could afford an $830,000 home. And in San Diego last month, there was about 1,700 homes available for sale at or below that price point, which was almost half of all the listings on the market. Now you can see that affordability has deteriorated as rates have climbed to 7%. They go from being able to afford, whatever that was, an $830,000 home at 3% to now a $580,000 home at 7%. And there's a lot fewer homes out there that they can now afford. And so, this is one of the reasons why we can expect, and we've already frankly seen, buyer demand start to moderate. We're consistently now underperforming the last couple of years of inflated levels of mortgage applications. But I actually brought the last decade of mortgage applications going all the way back to 2010. And last week was, the lowest second week of November that we've seen, going all the way back to 2010. So both because of that brother-in-law effect, where folks are, thinking we're just on the precipice of a foreclosure crisis, and also because of a reduction in purchasing power, you've seen these metrics of buyer demand shift toward the negative, right? And you see that, I think, first-time buyers in particular are going to be the ones that are going to bear the brunt because they don't have other investments to sell off. They can't step up and put more money down or buy their rate down with some more upfront cash. And you can see here that over the last year, but also slightly last year as well, that the good progress we made with a big surge of first-time buyers into the market, rising to all-time or at least decade high levels in 2020, have now started to moderate in the face of this shift in some of these broader challenges. And of course, we just put out our 2022 numbers for October, and sales in California dipped back down below 300,000 for now, the kind of second time in the last 4 months. So sales are currently down about 40% on a year-to-year basis, and you can see that we're moderating again from these kind of decade high levels that we hit back in 2020 and 2021. If you look at the pending numbers, we should expect that sales are probably going to remain relatively soft. Let me back up a second, though, and point out that we're also relatively close to the bottom that we hit back in 2007 and 8. And so although I don't expect sales to come rocketing back to 450,000 units where they were at in 2020 and 2021, we're also most of the way, I think, towards bottom. We'll see sales that'll probably be relatively weak again because of the pending numbers for the next couple of months. But, all of those life events that typically drive changes in housing decisions are still going on out there, right? People are still getting married. They're still having babies. Some of us are still getting kicked out of the house and have to go find new houses. And all of that stuff is still, going to help to provide a floor for overall housing demand. We just don't want to kind of throw it in cruise control and think that we've made it through the worst and that things will, have that kind of V-shaped bounce back to right where we were. It's going to take some time for inflation to get in check and for rates to kind of top out and normalize after having surged so incredibly over the last couple of months. But I think, again, this is where we really earn our money, right? Because you have buyers and sellers that think we're really dangling, on the precipice, whereas, in many ways, the market is just catching its breath after having been so out of whack in 20 and 21 with so many buyers and such a big pullback in terms of housing supply. that again, this is kind of vindication for my student loans, but that, supply and demand still works. And you kind of miss that when you're so hyper focused on the very scary headlines about what the Fed's doing, or foreclosures and things like that. And I think, again, it's all about providing some of that context, because in some ways, the slowdown that we're seeing is just, again, Econ 101 starting to work, right? Sales in California as a whole are down about 20% through the first 10 months of the year, but they rose about 12% or so over the previous 2 years, right? And so from that standpoint, things aren't as bad as what the headline suggests. And one of the major reasons why the market is down isn't because things are totally falling apart, but rather, that the top end of the market, $5, $6, $10 million homes, are no longer doubling the way that they were in 2021, and to a lesser extent in 2020 as well. So we just can't maintain a doubling or tripling of home sales in individual price brackets indefinitely, right? We just don't have the inventory for that. You can kind of see that same story playing itself out when you look at Southern California as a whole. Yes, we're down 23% in terms of transactions this year, but we were up about 14% over the course of the last couple of years. And so we're not as far behind the game as, again, what those newspapers would have you believe. You can kind of see the same story in Southern California if you look at it not by price point, but instead county by county, right? Because you can see, again, sorted from highest price to lowest price. And I don't have Santa Barbara in here, but you can see that, again, double-digit gains in the previous couple of years, and now we're giving some of that back as the market has shifted. So some of this is Econ 101, again, just taking a breather after having been so red hot and out of whack over the last couple of years. But I think, again, some of this at least is a little bit of this Fed war on inflation that's biting into the economy as well. And of course, we're also, seeing normalization on the supply front, right? Because at the end of last year, we had 1.2 months of supply, meaning that, if we didn't put any more homes onto the market in January of 2022, we would have been all sold out of homes by the time we got to Valentine's Day this year. And now we're seeing the number of active listings pretty much across the board in terms of price segments rising to the highest levels that we've seen in 3 years. And so we have less buyers out there, and the buyers that we still have more options to choose from. And of course, this is that supply and demand rebalancing itself and leading to an environment that's slightly less competitive that we've kind of been spoiled by. And so you have a lot of buyers who are like so zoomed in on the scary stuff, the tusks that are coming down the pike, and whatever the latest, kind of email they got from their brother-in-law was. And I think, again, our job is to step them back and really zoom it out and show them the bigger picture, that it's always a good time to buy a home in California if you're buying for the long term. It's still a great time to sell a home. We've just been very, very spoiled by the most competitive market we've really ever seen in California leading into this, right? And this is where I say, again, perspective is key. If you fall victim to the brother-in-law effect, right? And this is that same family in San Diego making 150 grand a year. If their brother-in-law gets it wrong, which I think, I don't have as much confidence, shall we say, in his analytical abilities, maybe as he does. If you wait and rates actually end up going up instead of down, right, then you afford even less homes and you have even less opportunity to buy out there. So the cost of waiting could actually be very high. And I think that's something that buyers miss the boat on when, again, they're so focused on what the latest Fed rate hike was looking like. And another, important piece of perspective for buyers, and my philosophy is never to convince anybody to do anything, right? We're not trying to tell you it's the best time to buy, the best time to sell. I think we're just here to provide the context and perspective so that you can actually make an informed decision, and not one based on kind of fear or panic about something that you just read. Because even as the market has normalized, right, and we have fewer buyers and more supply out there, prices are no longer growing by 35, 40% the way that they were last year. In fact, prices were only growing by less than 1% last month. But once you account for the effect of higher interest rates, the payment on that median priced home is still going up by over 50% on a year-to-year basis. And so if you wait, I guess, again, I'll just reiterate that there could be potentially a high cost of waiting, and especially if your brother-in-law misses the boat and we don't get that foreclosure crisis and prices are even higher next year and you're paying even higher interest rates, right? And you can see that ultimately the market is actually less competitive than it was over the last couple of years too. And that is good news for home buyers. If you've been a buyer out there who's been on the sidelines because nobody would consider your contingent offer, they had other offers that were all cash, or folks that could put more money down if you were trying to use down payment assistance or anything like that. In some ways, that was kind of a non-starter last year. And now I think you'll have sellers that are going to be more open to considering that stuff, because if you look at where we were at in Southern California as a whole last year, 3 out of 5 homes that closed were closing for over list price. And through the first 10 months of this year, those numbers have really started to come down across the board. It's still a relatively competitive market, but you can clearly see the shift here when you look at it from an annual standpoint. If you drill down to the weekly numbers, you can see that really that 60 or so percent is a function of starting closer to 80% at the beginning of this year, now tapering down into the kind of 25% range, meaning that it's still a competitive marketplace. 1 out of 4 transactions is still closing above list price. It's just not, almost 4 out of 5, the way that we were seeing earlier this summer. But again, as a buyer, that is good news for you. If you still want to get a home, if you still qualify, if you can still find stuff that you like and want to buy, and somebody said, marry the house, date the rate. And I largely agree with that. You can go out and refi when rates go down, unless you're one of these zero down type of buyers. I think, you're going to do pretty well by just, again, finding a house that you really like and getting into housing for the long term, the way that it's meant to be. And now you have more opportunity to do so, that the market has started to shift a bit. You also have sellers, again, that are more willing to negotiate. Almost somewhere between 30 and 50% of active listings, depending on price segment, have already reduced price. These are the actives that were on the market all the way up through last weekend. And we've gone from virtually nothing being reduced earlier this year, right, down in the kind of 10 to 20% range, even at the very top end of the market, to now, again, between 1 and 3 and half of all the listings that have, not sold have started to reduce price. And this kind of brings me to the question of managing expectations and how we work with sellers, right? Because you've got to be a lot more strategic than we've needed to be on the sell side in a very long time. It's still a great time to sell a home, but we just need to go in with level set expectations, because we're not back in that early spring environment where nothing was being discounted and homes were selling in a median time of 7 days. In fact, if you look at days on market, although the annual stuff isn't showing it as bad, the numbers are still up, right? We went from 9 days as a median time on market across Southern California last year to 11 days through the first 10 months of this year, which doesn't seem too bad. But again, when you look at it on a week by week basis, you can see now that days on market across price segments has doubled or tripled. We've gone from 7, 8, 9 days all the way up to about 20 to 25 days. Guess what? Homes are still selling fast, right? Again, that was just a really hyper accelerated marketplace. My dad was a realtor back in the late 70s, early 80s, and I think they had a median time on market at that time of like 85 days in San Diego or something like that. So again, still a great time to sell a home, but you just need to have expectations that aren't based on your buddy's experience from April, when rates were 3% and homes were flying off the shelf, right? And again, this is how you kind of both set yourself up for success, right? But also kind of avoid some of those angry voicemails from sellers who are blaming you for the market shift and thinking that it's somehow your inability to market their property effectively or anything like that. Again, this is where the data can really be your friend, because you can show them what's happening to the market and the types of trade-offs that they have to consider. Because part of a normalizing market and fewer homes going above list is that prices aren't rising as fast as what they have been, right? And so sellers in particular get very emotional about the number that they want to get on that home. And even though we haven't seen a big sell-off in terms of prices, price growth has slowed substantially. And that is important context for somebody to have who thinks that their home's going to go pending in 4 days and that they're going to get 20 over list price offers. You can see that prices in Southern California have grown tremendously over the course of the last couple of years. In fact, we're basically coming down off of 2 double-digit, years for price growth. But if you look at the numbers, comparing this year to last year, you can see that, again, that growth has really started to slow. It's not a catastrophe. It's not 2008 all over again. But again, we just have to have more level set expectations about the environment that we're selling these homes actually into. And, you want to remind those sellers that you can draw a red line in the sand on your price, but there's a lot of other sellers across price segments that are reducing, and you have homes that are taking longer to sell. And so this is kind of the decision that you have to make. If you're starting to get into that 25, 30, 35 days and you haven't got an accepted offer yet, we can stick to our guns on price, but it's going to cost us in terms of how long it's going to take us to move that property. And again, these are all conversations I think that are best had on the front end, because if you know that the market shifted and you're more prepared for having to have a couple of open houses before you go pending, then I think you won't be disappointed, because again, prices are still high. Even still have a lot of homes selling above list. We just can't be expecting the kind of shoot the moon type of environment that we've enjoyed up to this point in the cycle. The last thing I'll kind of say before giving you the gory details on the forecast is that even though the market is shifting, again, I want to just take a minute and try and really stamp out the kind of brother-in-law effect that we're on the precipice of a foreclosure crisis, right? Because I saw an article the other day, and you'll probably continue to see them, that says, hey, foreclosures are up 85% from where they were last year. And I always laugh at those because, we weren't allowed to do foreclosures last year. And so if you go from 0 to something, that's like an infinite percentage growth rate, right? But if you have $1 and I give you another $1, that's 100% increase, and you've still only got $2. And so even as, and this is what your brother-in-law's picking up on in the media out there, but the reality is it's not 2008 all over again. Even as owner occupants start to take a step back because some of those folks are going to be priced out of the market, you still have a lot of folks buying vacation homes, second homes. Folks at the top end of the income spectrum continue to punch above their weight economically, and in an environment with elevated levels of inflation. It's traditionally been a smart move to park your money in real estate. And I think that's what you're seeing in the 2022 data, is that folks continue to buy vacation and second homes. We also have investors coming back into the market that are also helping to provide a floor for transactions, right? And they're looking at those same long-run fundamental price trends that I spoke about in terms of being a wealth generator, which is, with too many people in the state, not enough homes to put them in, prices over the long term can only ever go one way, excuse me, meaning that it makes sense to own property in California and, in fact, own as much as you possibly can, right? We're also trending toward becoming a majority renter state, which means that demand for rental properties will only continue to grow. And you can see the vast majority of these investors are buying properties to hold and rent over the long term. So again, even as sales are down, we're not going to see the bottom fall out of the market, because at least some of this kind of pullback in terms of that retail owner occupant will be supplemented by, second home sales and investors coming back into the market. The other thing I guess I should say is that investors maybe don't even care about 7% rates, right? Because, and then maybe even prefer them because it gets all those pesky home buyers out of the way, I guess, so they can gobble up more of our single family housing stock. The other reason why I don't think we're on the precipice of a major foreclosure crisis is because as of the third quarter of this year, 98% of the mortgages here in California were being paid on time, right? And if you go back to 2008, the year right before the official recession started in 2009, delinquency rates in California were already running around 7%. And again, I don't want to belabor the fundamentals of the mortgage market, but we were really only skimming the cream, as it were, when it comes to mortgage originations and underwriting over not just the last couple of years, but the last decade leading up to this shift, right? Because it was only going to folks with 720 plus credit scores, folks that were putting money down at DTIs that were actually underwritten, income levels that were verified. They're in fixed rate mortgages at the lowest rates of all time. And the overwhelming majority of folks in those hyper low mortgage rates also have a lot of home equity. And so again, that is not a recipe for throwing your keys back to the bank just because of economic uncertainty, right? In fact, even as the economy gets difficult, I think folks are going to be prioritizing keeping these homes going, right? Because, you know, even folks that are like getting divorced, right? You could sell your $1 million home right now that you had a 3% mortgage on and go buy two $500,000 homes. And you're probably going to be paying almost twice as much as what you're paying for your current residence, even though the principal balance is going to be the same. And that's the effect of rates. And so even folks with every reason in the world to move are probably going to be motivated to find some way to hang on to those homes. And indeed, you can see that in the new listings data, right? What I showed you before was the total active inventory, how many homes are available for sale week by week. And those numbers were up, but they were up because homes aren't selling as fast, right? So we were taking more of last week's listings into this week, which increases the number of overall actives. It's not because folks are dumping properties. In fact, this is the number of new listings. How many did we put onto the MLS week by week, going all the way up through last weekend? And you can see here that, you know, sellers are not heading for the exits, right? They are trying to hold on to these homes, even in the midst of a market shift with lots of home equity and all of that stuff. In fact, these numbers are actually down about 25 to 30%, depending on the region, from where they were even last year. And last year, inventory was depressed. So we're not going to have sellers dumping properties onto the market the way that we had in 2008, when there was a major REO crisis and roughly 60% of the MLS at one point were bank-owned properties, right? You're going to have still ongoing tightness in terms of inventory. And even though this means that probably sales are going to remain low for a while, right? And this is why I said we're not going to come shooting back to 450,000 units over the near term. This is also going to be the thing that prevents more steep price declines, right? Because inventory, although up from those hyper depressed levels during the pandemic, is still very, very tight. And you've, again, still got folks at the high end of the income spectrum that are doing relatively well. And again, you know, that's kind of why I think your brother-in-law maybe missed the boat when he's projecting 30 to 40% price declines. And it makes all the sense in the world to wait to buy a home, because the reality is, even if prices do come down, and we think they might a little bit, it's not going to be enough to offset the impact of those higher rates. And, you know, you don't have any of the ingredients that you need to precipitate a foreclosure crisis out there. Last thing I want to point out before I give you the forecast is that rates are still pretty low by historical standards, right? We were at 6.61% last week. And if you look back over time, you're hard pressed to find a period, sustained period, where rates were much lower than they are now. In fact, if you go back to the housing bubble, we were doing about 500,000 home sales a year, and rates were virtually identical to what they are right now, right? If you go back to the dot-com bubble, we were doing 500,000 or so home sales a year, and rates were almost 9%. I'm the son of a guy who used to brag about his 12.5% mortgage interest rate back in the 80s, when his buddies had, you know, 15, 16% rates. So it's not the level of rates that's particularly problematic right now. The challenge is that we're just adjusting because we're in an environment where prices were set based on the lowest interest rates of all time, and now incomes and purchasing power are adjusting to the new kind of normal out there. And so, yes, I do think that this Fed's war against inflation will put us into a modest recession. But if you look at our forecast for economic growth next year, we only have GDP going down about 0.5%, and that is not a deep recession by any stretch of the imagination. I think this tends to be towards the more pessimistic side I would argue it's the more realistic side relative to other economic forecasts out there, but it is not a deep recession. In fact, we have unemployment that stays in the low single digits, and outside of last year, it's one of the lowest unemployment rates that we've seen still in a very long time. The housing market, though, will kind of continue to languish. I think we have sales going down about 20% this year, and we have prices slowing from double-digit growth 2 years running to just 6% this year. Next year, we have sales remaining soft, and that's why I said keep your nose to the grindstone, because we have a 7.2% decline in transactions. But if you look at the level of sales that I'm forecasting here, it's 333,000 units, meaning that we're already most of the way towards bottom. They'll probably stay below 300,000 for the next couple of months before they start to gradually creep up. But this means that the bottom won't fall out of the market, right? That we've seen most of the decline, and that we won't see things continue to accelerate towards the downside. We do have an 8.8% decline in home prices. Part of that is because of the mix of sales. And I showed you how we went from doubling 10 million and up transactions to now relatively flat in that price segment. That's going to exaggerate the price declines in the same way that it helped to exaggerate the price declines in this 19.3% increase that we had last year. But we do see prices going down about 4 to 5% probably of real honest to goodness value hit, just because, again, folks can't qualify for the same amount of home that they could last year. But certainly not 2008 all over again. And again, I think this is where we really are going to have to embrace our role as the trusted advisor, because you've got consumers that are so hyper focused on the scary stuff that they're missing the bigger picture about the long-term value of home ownership on the buy side, and the fact that even as the market has shifted, it's still a great time to sell your home. You just have to come into it knowing that we're not at the lowest interest rates of all time. And I think that if you do that, you're not just going to kind of survive the next 12 to 18 months. You're really going to have stepped in and helped these buyers and sellers see that bigger picture at a time when they really, really needed you. There's so much noise and kind of scary stuff happening in the headlines. And yet again, I think the long-term benefits of home ownership are completely unmarred by the current economic cycle. You just got to find a house that you like, that you can certainly afford. I said, marry the house and date the rate, but make sure you can afford the current rate, and that if rates do go down and you're able to refi back down to 5%, that's just all kind of gravy for you. And I think the agents that do that and embrace that role as trusted advisor are not just going to survive, but are going to thrive. We just can't take it for granted. And again, the good news is that the consumers need us more than ever. The bad news is that the consumers kind of need us more than ever, because there's just a lot going on. And so we've really got to step up our game. And so with that, I would say thank you so much to Jamie for the opportunity to speak with you all today. And thank you to Rachel for helping me set all of this stuff up, and happy to entertain questions. Great.
What opportunities do you see in this market for realtors?
Yeah, I think, again, this is where the kind of good agent is going to be more critical than ever before, right? Because on the sell side, you're going to need to be more strategic. We're going to really need to beat the bushes. We're going to have to find new ways to make sure that the transactions get done. Like, one of my friends, Troy, up in Ventura, wrote an article about getting sellers to do rate buy downs, right? That's one of the options, I think, that can both really help buyers circumvent some of this purchasing power impact, right? That they're not able to finance in rate buy downs. And so if they don't have cash on hand to get their rate down from 6.5 down to 5.5 or something like that, it could be a deal breaker for getting that house. Whereas a seller can kind of step in and do that rate buy down for them, and it actually enables that buyer to qualify for more money. And so in some ways it helps the seller get closer to the number that they really want to get to for emotional or whatever other reasons, and lets actually buyers kind of have more purchasing power and maybe even finance in a lower rate that's really going to add up to a lot of savings over the long term. That's just one example, but I think there's lots of strategies and tools that the good agent is going to be able to bring to the table and put in front of their clients, that's going to make them, worth their weight in gold, right? And I think the agents that do that, nobody's going to be like, man, what am I paying this agent for? It's like, man, I'm going to hire, I'm going to call Jamie back every single time, because she just crushes, and that I think is, again, the recipe for success. Is we're going to have to bring out our whole bag of tricks, rate buy downs, and all the other, kind of stuff that you got in your back pocket, and use it all, because again, they really, really need us. And that's why, even as the market's going through this major shift, I'm still optimistic, because the really good agents, have all that experience and have all of those tools. And that's how you don't just kind of keep your own market share going while sales are down at 300, but when they go back up to 500, you're going to be, just absolutely dominating. And so I think that is what it's all about.
Very nice. Another question for you is, seasonally, November through December, sellers come off the market and buyers stop looking. Yeah. Why should they stay in the market through January?
Because rates are going to keep going up. I think is one of the most immediate reasons, right? I think, I especially now that rates dip back down to 6.61. I mean, that's a 40 or 50 basis point decline just in the last couple of weeks. I think you're going to see buyers that are going to flood back in because they're worried about rates going back up to 7.5%. And you can be one of those sellers that can take advantage of this uptick. I mean, you see it almost every time. The rates go up, mortgage applications go down, rates go down, mortgage applications go back up. People still want to buy. The number of sales isn't low because people don't want to get into the housing market. They're just scared about the economy, and some folks can't afford anymore. But you still got a lot of high income earners here in California. In fact, just as a kind of funny little anecdote, we calculate a housing affordability index every quarter and talk about housing affordability in California. And a lot of markets now, we're almost unable to do that because you have so many folks that are earning $400,000 and $500,000 a year, and the data that we buy doesn't actually disaggregate people way up that high. They never envisioned having to break out people making between 500 and 750 and 750 and $1 million, but there's actually a substantial number of people in those upper income categories, which is a good thing for our state. It's just a bad thing for my ability to generate a housing affordability calculation. But I think, again, it's hitting the first-time buyers, it's hitting the middle class, but we've got a lot of high-income earners that are still doing pretty well. And I think, that's why, even though the top end of the market isn't doubling anymore, if you go back, and I'll send these slides to Rachel and Jamie, so that you guys have these to talk through with your clients and things like that. But if you go back and look at the 10 million and up, even though it's not up by 110% or whatever that was, it's actually still flat. So those high-end home sales are still maintaining relatively high levels of transactions, even through this market shift, right? And if you're buying a $10 million home, rates go up to 7%, you just put a little bit more money down, or you end up just buying it cash or what have you. And that's why, even though, they're not going to double next year, but I don't think you're going to see the bottom fall out, and why, again, I think that we can still be optimistic. It's just, again, pedal to the metal for us.
Interesting. Sounds great. Another question. Lots of sellers are moving out of state. Is that good or bad for the California real estate market? Will it help affordability?
I'm going to categorically say it's bad. It might be quote unquote good over the short run because we have excess demand and not enough housing supply. But solving supply issues by killing off demand, to me, is the absolute worst possible way to address a supply crisis, right? It's like, oh, well, then let's just make it so unaffordable that everyone wants to leave. That is not a recipe for success long-term for our economy, right? We need, and especially if you look at who's leaving, it's people we really, really need, right? Like, you could arguably say, the Phil Mickelsons of the world or whatever, which I know that gets like a lot of media when the PGA, pros leave California. We could afford to probably lose the PGA Tour professionals, but what we can't afford to lose are all the people that are actually leaving: our police, our firefighters, our teachers, our middle managers, our construction workers, all of the tradespeople, right? Like, we have a housing supply crisis. How are we going to build our way out of this thing if all the carpenters now live in Arizona, right? And so I think that it's bad for the housing market. I think it's bad for our economy. One of California's biggest strengths is that we're the fastest growing economy, or at least in the top 5 consistently every year out of all the states in the nation. But if we can't fill jobs because people realize it's better to be a tech worker in Denver, where I can have a killer 3-bedroom apartment for the cost of, what it would cost me to have a studio like up in Temecula or something, then, it's gonna inhibit our ability to continue to be the best, economy in the nation. So for me, that one's easy. It's a bad.
Good. So we're almost at the top of the hour. So I have one last question for you. Do you think inflation can get above 8% this year, or rates go above 8% this year?
My worst case scenario, which is not my forecast, we think the peak for rates is probably going to be somewhere in the 7.5% range next spring. So they'll go up a little bit more, but the Fed will probably be able to stop doing the crazy 75 basis point rate hikes each time. But I think worst case scenario, 8.5%. I saw an article the other day that said, the market should brace for 10% interest rates or something like that. And I don't see that coming down the pike, but I do think there's a possibility that they could go higher than 7.5%. I think there's a smaller chance that they won't get as high as 7.5%. But, and I think they won't stay up there very long. Again, once they break the back of the economy, and consumers aren't spending as much, then you'll see them be able to kind of take their foot off the gas. And I think even by the end of next year, you might see rates go back down into the 6.5, maybe even lower range, right? But it's just going to come at the cost of a modest pullback of consumers and a slight decline in overall economic activity. So.
Well, thank you so very much for all of your wonderful insight and information, Jordan. And I'm now going to pass it back to Jamie Duran.
Hey, everybody. So I just wanted to thank Jordan so much for that great presentation and all the information. There really isn't a housing crisis. I think the facts have shown that today. There is an information crisis, though. So we really need to be very clear about what the facts are and what the information is, and get out there and, spread the information out to our buyers, sellers, and investors. Let's continue to be the trusted advisors for our clients. And as buyers and sellers and investors out there, let's grab onto the opportunities of this great market. This is not a bad market. This is a market full of opportunity. So let's go out there and get it. Thanks, everybody. This is recorded, so you can always flip back and check it out. Thanks again, Jordan. Great job. Bye, everybody.